This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Today, we're going to be talking about avoidable surprise number 7, increasing the productivity of your wealth. This is one of the surprises that can sneak up on you when you're investing for your future and you're an executive and you're trying to build your wealth and you're putting money away every month or every year or however you do it, maybe out of your paycheck. And so what I'm going to be talking about are tips on how not to waste your wealth. In other words, take the same dollar amount that you're saving and make it be worth a lot more. The whole concept of this short talk is about what's called opportunity loss, which is really when you don't choose your best alternative. So when that money comes in, your paycheck or whatever it is, if you own a business, that excess money, you really need to just choose your best alternative. And so you don't want to have wasted wealth, fruitless time, unused potential. So how do you optimize? Well, the first thing to make sure that you're doing is that you're optimizing your tax status. So the situation is you're saving and investing every month, let's say. And the problem that you have is there's a ton of choices out there and it's like, what's the best one? So there's basically 3 types of accounts. And I think the first thing is to be aware of, hyper aware of, there's fully taxable accounts, there's tax deferred accounts, and there's tax-free accounts. And so let me go through really quickly and explain what they are. If you probably already know what they are, but just to make sure, a fully taxable account basically says, I'm going to pay taxes on the earnings now that I earn, and I'm going to be paying taxes on the earnings that I earn in the future. So it's always taxed. A tax deferred account is one where you save on taxes now, usually. You might even get a tax deduction now, like an IRA or 401k, and then you pay taxes later. So that's your other option. And then your third option generally is tax-free, where with after-tax money, typically money, if you're earning money, it's money that you've already paid taxes on. So you pay taxes now, but you save taxes later because you never pay taxes on that ever again. So the implication of this is, how do I know which way to go? So there is really only one true way to know for sure, and that is to actually forecast out your income and expenses and when you retire, your particular situation. Some people, it's better for them to put more in one or the other. And in the last video that I did, I talked about tax diversification, where basically we're saying you need to diversify across these. So when things change, you can have some options. But if you look on page 26 of my book, Financial Freedom Blueprint, I have an actual section on this, and I show a graph where if you put $500,000 in, and if you put that money in a taxable account, and you only earned if you earned 6% and you paid taxes on it, that it would be worth about 1.1 million. This sounds pretty good after a long period of time, actually. So we're talking about a long period of time. But if you did the same account in a tax deferred account, you have 1.6 million. So you gain like $439,000. So what we're talking about is a big deal. We're not talking about like chump change. We're talking about big numbers if you're not optimizing. Hi, if you like this information, be sure to subscribe to our YouTube channel, hit the like button, also share it with your friends. And to get the free report, the 10 avoidable surprises that derail executives planning for retirement, go to retireready.live and get your free copy. Tax-free is different. The calculation is different. It's all about the 2 things. What am I paying now on the taxes, and what am I paying in the future? And there's basically 3 combinations. So that's the first thing, is to optimize that. So, and the way to solve that problem is to basically go through and forecast out which one's better for you. Second one is optimizing the investment strategy. So this is a common situation. As your money starts growing over time, inflation and taxes really eat into your money. It's a big deal. And so the average retiree is going to see their expenses more than double usually in their retirement years. So you got to have a return that's significantly bigger than the inflation rate as well as your spending rate. So you need to cover both how much you spend as a percentage of your assets plus the inflation. So the question is there's a ton of choices, right? That's the big problem. is, I mean, you look right now, and actually I just ran some screens and I don't have the report with me. There are thousands and thousands. Let's just take exchange traded funds. There's just thousands and thousands and thousands of them. And many of those funds have almost the identical holdings or the identical holdings in them, but they have different fee structures or different payouts in the dividends. There's just a lot to choose from. So it really is important to be able to understand several key things with the investments. The first one would be, what expenses am I paying? And the second one would be, is what is the opportunity of that investment? And the opportunity is really based on quality, valuation, and technicals. That's the most important thing I always talk about. So the problem is there's too many stocks and bonds to choose from. There's over 10,000 stocks, for example. And we're big proponents of owning stocks directly, because you have direct ownership and you have control. You avoid unnecessary taxation. The implication is that you've got to match your situation with your needs for the investment. So that means you have to look at several things. First is, we talked about quality, value, and technical. Those are the diversification and the growth. Got to look at those things first. So how good are the actual investments that you have, and what is the diversification? And you need to match that to your situation. And the way you do that is with a simple thing called an investment policy. An investment policy sounds really kind of hoity-toity, but all it is it's matching your situation based on your return requirements, your time horizon, your risk profile, your liquidity requirements, how quickly you'll need the money, what your tax situation is, do you have any legal or other constraints that are involved, and just putting that together, and any preferences that you have. You got to be careful with the preferences, though, because if you have too many preferences, you can constrain the portfolio and you won't be able to make good money. So we've seen that happen too. So to go over that again, optimizing your investment strategy, you need an investment policy statement, and you need an analysis of the opportunity, how much opportunity and risk is involved in each one of my investments. So just wanted to let you know that you can get this book, by the way. It's on Amazon if you'd like. You can jump to Amazon and get it, or you can get a hold of me at wealthnetinvest.com, and we will send you a copy. You could just go to info@wealthnetinvest.com and get a copy of that. There's lots of information in there. Okay, so now let's talk about the next part about not optimizing your money. And this has to do with investing early and investing often. So that's one of the things that we see a lot of times. People will tend to sit on cash when they shouldn't. And maybe it's because they're nervous, or maybe it's just because they think, oh, I'll do it at the end of the year after I do my taxes. We see that tons. That can mean a lot of money in your pocket over time. So the situation is sitting on too much cash, too large of a cash reserve. That's the number one thing that we see. So the rule of thumb for knowing how much cash you should hold, and this comes out of the Financial Planning Association's guidelines, is to have 6 to 12 months of your expenses set aside in a cash reserve. So if you are a 2-earner family and both of you are earning an income, then you want to have probably around 6 months worth of expenses, or you'll replace the income of one of the earners, probably the one that's the highest. And then if you have 12, if it's a single earner, you want to have 12 months. If you own a business that is very volatile, you may want to have more, but that's very rare. So that's the first thing, is don't hold more than you need to hold, because part of your portfolio should also be diversified in a way where you can also get to it. So you don't want to have too much. That drags down your portfolio returns a ton, because interest rates are very low and you lose out quite a bit. And it means a lot of money over time. Second is, a lot of times we see people will use a big lump sum of money that they have to pay off something where they get a low benefit for doing so. Sometimes people will use a big lump sum of money, hundreds of thousands of dollars sometimes, to pay off maybe a very, very low interest rate debt, which doesn't make sense because they don't have any other debt, for example. Or they may use it for other purposes where they could have had a different source of funds that they're using, and they're using money that could grow. That's an opportunity loss, not making the best choice, and it doesn't make sense. But you have to make sure, obviously, that your debt is in check and all of that first. So the thing is, you got to get time on your side. That's the biggest part about this particular one. So early and often is the rule. So if you have money that you're saving, say monthly, do it at the beginning of the month, not the end of the month. Don't wait till the end of the year and just hold up a bunch of cash. It really means a lot because you could be dollar cost averaging into your investment and do better, much better actually, depending on how old you are. The second thing I would say is that when you get time on your side, you need to make sure that you're doing it more often if you can. So if you normally do it annually, think about doing it monthly. The next one has to do with the order of withdrawals. So let's say you're now retired and now you're taking income out. The situation is that you need to figure out which particular account do I need to take this money from and how do I take it out? And so there's a lot of little things to think about actually that wind up having a big impact on your wealth, but you need to optimize how you withdraw your money. So the way you do that, one of the biggest problems we see is that the taxation and the costs that are associated with which account you take money from are not considered thoroughly. So which account do you pull from? So there are, there's a real risk that you could run out of money. You could run out of money really fast if you don't do this correctly. So the way to do it is to use an efficient order of withdrawal. So also in the book, I keep coming back to the book, but on page 32, I actually have a graph that will explain the order of withdrawals. And it shows, depending on your age, how old are you? Do you have taxable accounts now or that have money in it or not? Are you taking required minimum distributions now? And do you still need more money after the required distributions? If you do, are your tax rates going to go up or down in the future? Most likely. And do you have tax-free investments or tax-deferred investments? And then which ones do you take it out? So in practice, what we do is every single year, it's a good time to assess how to do that so that you can optimize given the tax laws in that year, because the tax laws, as you know, are changing every year. So there you have it. Those are the three things that I wanted to talk about now, having to do with optimizing your tax status, optimizing your investment strategy. Actually, there's four things: not investing early and often, and your order of withdrawals not optimized. So I'm going to, you can get a copy of this report. It's called the 10 Avoidable Surprises That Derail Executives for Retirement. You just go to retireready.live. So go to retireready.live and get that free report. And we will send you information on some of these things that you can avoid and have a much more fulfilling retirement. That's all for now. Louis Llanes with WealthNet Investments signing off. Hope you're having a great day. Bye.
The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals. If you like this information, be sure to subscribe and follow us on Twitter and Facebook.